Welcome to this in-depth video on cryptocurrency, where we'll take you on a journey through the history, technology, and future of digital currency. Whether you're new to the concept or have been following crypto developments for a while, this video will provide a comprehensive guide to understanding how cryptocurrency started, how it works, its role in today's world, and what we might expect in the years to come. Over the next 9 minutes, we'll cover everything from the origins of Bitcoin to blockchain technology, altcoins, real-world applications, and the potential risks and rewards. So sit back, grab a coffee, and let's dive into the fascinating world of cryptocurrency. Before we get into cryptocurrency, let's take a look at the broader history of money. Thousands of years ago, humans engaged in barter, direct exchanges of goods and services. But this system had limitations. What if someone didn't want what you had to trade? Enter the concept of money, something universally accepted in exchange for goods. The earliest forms of money included items like shells, grain, and cattle, but these were inconvenient to transport and store. Around 600 BC, metal coins made of precious materials like gold and silver became common. These coins held intrinsic value, but they were still cumbersome for large transactions. Fast forward to the Middle Ages, and we see the introduction of paper money. This was a game changer because it was much easier to carry than coins, yet it was still backed by physical commodities like gold and silver. This system, known as the gold standard, persisted well into the 20th century. However, by the mid-20th century, we moved away from the gold standard, and money became what we now call fiat currency. Fiat money has no intrinsic value. Instead, its value is derived from government regulation and the trust people place in that currency. But then came the rise of the internet. As online commerce boomed, there was a growing need for digital payments, and this gave birth to ideas for digital currencies. In the late 1990s and early 2000s, several attempts were made to create digital forms of money, but none succeeded, until 2009, when Bitcoin was born. Chapter 1: The birth of Bitcoin and the creation of blockchain technology. In 2008, an individual or group of individuals using the pseudonym Satoshi Nakamoto released a white paper titled Bitcoin, a peer-to-peer electronic cash system. This white paper outlined the fundamental principles of Bitcoin, a decentralized digital currency that could be exchanged directly between individuals without the need for a bank or government intermediary. The innovation that made Bitcoin possible was blockchain technology. Blockchain is essentially a distributed ledger, a digital record that is maintained by a network of computers called nodes. Each time a transaction occurs, it is bundled with other transactions into a block. This block is then added to a chain of previous blocks, creating a transparent and tamper-proof ledger. Here's where it gets interesting. Unlike traditional currencies, Bitcoin has no central authority. Instead, transactions are verified by the collective power of the nodes on the network. This decentralization ensures that no single entity controls the currency, making it resistant to censorship and fraud. The first Bitcoin transaction took place in January 2009, when Nakamoto mined the first block, known as the Genesis block. Bitcoin slowly gained traction over the next few years, but it wasn't until 2010 that it made headlines. That year, a man in Florida paid 10,000 Bitcoins for 2 pizzas. At the time, that was worth about $41. But today, those Bitcoins would be worth hundreds of millions of dollars. Chapter 2: How blockchain technology works. Blockchain is often described as the backbone of cryptocurrency. But how does it actually work? Let's break it down step by step. A blockchain is a series of blocks, each containing a list of transactions. When a transaction is made, let's say Alice sends Bitcoin to Bob, that transaction is broadcast to the network. Here, nodes, which are essentially computers running Bitcoin software, verify that Alice actually owns the Bitcoin she's trying to send. Once verified, the transaction is grouped with others and added to a new block. This block is then chained to the previous block using cryptographic hashes, creating a secure and permanent record. What makes blockchain special is its decentralized nature. Traditional banks have centralized ledgers that they control. Blockchain, on the other hand, is distributed across all the nodes in the network. This means that even if a few nodes go offline, the blockchain remains intact and operational. Furthermore, the blockchain is incredibly secure because altering a block requires recalculating all the subsequent blocks, a nearly impossible task due to the amount of computational power required. This makes blockchain resistant to hacking and fraud. Beyond Bitcoin, blockchain technology has a wide range of applications. Ethereum, for example, introduced smart contracts, self-executing contracts with the terms of the agreement directly written into code. This has opened the door to decentralized applications, dApps, and decentralized finance, DeFi. Chapter 3. Altcoins. Bitcoin's competitors and the rise of Ethereum. While Bitcoin may have been the first, it certainly wasn't the last cryptocurrency. Over the years, thousands of altcoins, alternative cryptocurrencies, have been created. Each altcoin has its own unique features and use cases. Perhaps the most notable of these is Ethereum, which was introduced in 2015 by programmer Vitalik Buterin. Unlike Bitcoin, which was primarily designed as a store of value and medium of exchange, Ethereum was created as a decentralized platform for running smart contracts and dApps. Smart contracts are one of the key innovations of Ethereum. These are contracts that automatically execute when predefined conditions are met. For example, imagine a rental agreement where the payment is released to the landlord automatically once the tenant confirms they've moved in. Smart contracts eliminate the need for intermediaries like lawyers or escrow services. Other popular altcoins include Litecoin, which was designed to offer faster transaction times than Bitcoin, and Ripple, XRP, which focuses on providing efficient cross-border payment solutions. However, not all altcoins are created equal. Many have fallen by the wayside due to poor development, lack of use, or outright scams. This highlights the importance of doing your own research before investing in any cryptocurrency. Chapter 4. The current state of cryptocurrency today. The cryptocurrency market is worth over $1 trillion, with Bitcoin leading the way as the most valuable and widely recognized digital asset. Cryptocurrencies are no longer a niche interest. They are becoming a major force in global finance. Many large companies, including Tesla, PayPal, and Microsoft, now accept Bitcoin and other cryptocurrencies as a form of payment. In addition, some countries, such as El Salvador, have even adopted Bitcoin as legal tender. But with this growth comes increased scrutiny. Governments around the world are grappling with how to regulate cryptocurrencies, especially in areas like taxation, consumer protection, and anti-money laundering measures. Despite the regulatory challenges, the rise of decentralized finance, DeFi, is providing new opportunities for financial innovation. DeFi platforms allow users to lend, borrow, and trade assets without needing to go through a traditional bank. This has the potential to revolutionize the financial industry, particularly in parts of the world where banking services are limited. Chapter 5. The future of cryptocurrency is so. What's next for cryptocurrency? One of the biggest trends we're seeing is the development of central bank digital currencies, CBDCs. These are digital versions of national currencies, regulated by governments. China is leading the charge with its digital yuan, and other countries like Sweden and the US are exploring similar projects. At the same time, blockchain technology continues to evolve. Newer consensus mechanisms, like proof of stake, are being developed to reduce the environmental impact of crypto mining. Ethereum, for example, is transitioning from a proof-of-work model to proof of stake, which uses significantly less energy. Another area to watch is the intersection of cryptocurrency with artificial intelligence, AI, and the Internet of Things, IoT. These technologies could further enhance the capabilities of decentralized networks and open up entirely new use cases. However, the future isn't without risks.